But walk you through my quick story, right? My 90 seconds.
There you go.
All right. So I did the finance and economics thing in college, came out during Wall Street. That was a terrible time. Oh, in 09, excuse me, into Wall Street. That was a terrible time. So I did a quick pivot and started a study abroad company in Costa Rica. Lived there for 6 months, on and off for 3 years. Ended it at around 500 kids a year at $4,000 a pop. So I was doing about $2 million in revenue living in Costa Rica at 22 years old. Of course, I had some partners. When you're 22, ego, hormones get in the way. Whole thing fell apart. I took my cash winnings, bought my first couple of houses. That's how I accidentally started syndicating. I had gotten a gig working for one of the very first unicorns that IPO'd back in 2012. Bunch of 30-year-olds all of a sudden had $1 million, and they started throwing cash at me because they heard that I was getting 20% cash on single family homes in 2012. So I scaled that to about 2 million assets under management. I had worked for free with that study abroad company, so I had a zero net worth. And then all of a sudden, just by partnering with people, I had ballooned to a half a million net worth just by using other people's money. So I was able to take that to the bank and start doing my own stuff. I met my wife. I moved out to Denver, wanted to put myself into a national spotlight so I can network with people nationwide. I was in a new city. I didn't know anyone. So I started the Best Ever Conference with Joe Fairless. And that was meant to just be a trade event for commercial real estate investors, hustlers, entrepreneurs, not the looky-loos or the mom and pops and not your coastal institutional money, but that mid-market entrepreneurial real estate investor. And from there, I found my partners, like so many others that have been to the Best Ever Conference. And we now own $500 million of self-storage at Spartan Investment Group. And we are building a great company, 5th fastest growing real estate company on the Inc. 5000 this year.
Let's start with this. Okay. You talked about growing this study abroad company as a young person, fresh out of school, 22 years old, spending your time out in Costa Rica, selling that company and kind of transitioning. And you said you kind of fell into, syndicating a little bit and had some unicorn investors. I want to have you kind of elaborate on that a little bit. But had these unicorn investors who realized you were making good money with these single family homes and gave you money to invest. And that really kind of got you going with partner with other people, leveraging the capital that they have that they're looking to invest, and ultimately getting into the syndication space, which obviously led to some of the future things with Best Ever Conference. Let's go back to kind of that time working with these unicorn investors, because that's the dream scenario for most syndicators, right? Is you put yourself in a situation where you're attracting high net worth individuals who are happy with passive returns that you can generate, and they're just throwing money at you as an operator. So what was it you were doing at that time that allowed you to attract these investors? And what is it that they were looking for that kind of put you in a unique position to be successful there?
Yeah, so I think it was my role at this company that was very helpful. I was 23 years old. I was the only person on my team that didn't have an MBA. My job working for an ad tech company in New York was to bridge the gap between this new team in 2012 called Artificial Intelligence that was automatically managing campaigns. It was an advertising technology company on behalf of brands like Dick's Sporting Goods or I don't know, every brand, Cox Communications, we had hundreds of Fortune 500 companies as clients. And the sales team who was supposed to go out and sell it. So my job was to not only manage the campaign, but present insights that made the salesperson look smart, and then say all this hullabaloo about artificial intelligence and machine learning that nobody really understood at the time, and big data and all these really cool buzzwords in 2012 that would help them sell. So I had two things that I had to do really well, which was be a good tech salesman, be a good support person that made the salesperson look good, and then also manage the campaign in a way that helped them upsell. And I did both of those things really well just by having a personality and a quantitative mind, which apparently people keep telling me is on the rarer side. So because of my position, I became the counsel for these salespeople who were making $500,000 a year with stock in this pre-IPO company. I was the person that they went to when they needed help. I had all the answers. And so I was looked at naturally as somebody who knew what was going on when they did it. And then all of a sudden, 8 months after I started, the company IPO'd and it doubled in value. Of course, eventually, the company was called Rocket Fuel. It sunk in value to 5% of its IPO price, got bought by a company that went bankrupt. So it's no more. But at the time, They all of a sudden they had $1 million and they were making $500,000 a year and they were super flush with cash, but that still wasn't enough to buy an investment property in New York City, which is where we were based. And so people had heard that I was buying these $50,000 4-bedroom, 2-bathroom houses in the Richmond area for like 80 grand, putting $20,000, $30,000 into them and getting $1,200, $1,400 in rent. So I was getting 20% cash on cash returns with 15-year mortgages. And people didn't really understand that. They just knew that I was putting $50,000 in and getting a 20% cash on cash return. I was getting $10,000 every year with a $50,000 investment. And I only had 2 of them because that's all the money I had gotten from my study abroad company. I didn't get very much from that company. But when folks started hearing that, I didn't have to approach anybody. I didn't even think of this business model. Somebody else said, hey, can you do that for me? And I said, sure, I'll just take 25% of whatever you do. I'm not a broker. I can't take a fee. I'm not a fiduciary, so I'll take 25% ownership. You put in all the money, you put your name on the mortgage. I'll take 25% of the cash flow and 25% of the upside when it sells, because I know this thing's going to double in however many years. And so that happened. 3 years later, I had 12, 15 of those properties, and I decided to pursue an apartment building. Syndicated on purpose, a 38-unit apartment building. And so I had over 50 units by the time I was 25 years old. I had a $500 million net worth that had started from $800 2 years earlier without having any liquidity events, just on paper. And then I was able to take that half a million net worth and bring it to the bank as a guarantee to start doing some of my own stuff.
Man, that's incredible, right? So you started really with just these 2 kind of out of market houses in Richmond while you're living in New York. You had these 2 out of town properties. People heard what you were doing and they were looking to invest as well. And that really took you down this journey. Just some really great insights. And I think one of the things there is, and you didn't really say this part, but maybe you can clarify, how did people find out that you were investing in Richmond?
Well, I had heard this great quote, or not quote, it was advice from somebody who I worked with. When you want money, ask for advice. And when you want advice, ask for money. When you're seeking wisdom, ask for money. Because when you ask somebody for money, it's this direct ask for their personal resources. When you ask for somebody's advice, it's asking them to give them a part of themselves that they want to share already. And when they offer their advice, they're offering a piece of who they are to you. And if you show them that you are receptive to it, you don't have to necessarily institute all of it, but if you show them that you are receptive to it, that you're grateful for it, and that you are open to hearing more of it in the future, now all of a sudden they've got this emotional tether to you and they want to see you succeed because they want to validate that their advice was worthwhile. So if they want to see you succeed, they're going to start contemplating what resources can I throw at you to see you succeed. And so the very first person who actually told me that advice, he said, you basically just asked me for advice and now I kind of want to give you money. I don't think I would have given it for you if you directly asked me this. But I think you should start asking people for this because you have a decent business model here. And that guy was my boss's boss at work. So he was totally down with me doing my job and doing this on the side. It was a very cool setup.
That's amazing. So did you just ask him advice on how to do it? Or what was the question that kind of sparked the dialogue?
Well, okay. So I had a falling out with my business partners doing the study abroad company. I tried 2 other startups that failed very quickly. So 8 or 9 months later, I was out of cash, and I got this job not because I had an interest in it, but because I needed cash. I needed a job. So I got this job, and it ended up being a phenomenal job. I learned about big data. I learned about business operations. I saw a very fast scaling company explode and then blow up. And I was working with intelligent people who were also super fun in a very fun and sexy industry. So it was a great place to be that I happened to fall into. And my boss's boss saw that I was an entrepreneur, and that's why he wanted to hire me, even though I had no background. He had been an entrepreneur in college too. And so when I had this falling out with my business partners, it came to a head in kind of a legal way after I'd already gotten this job. And so I started asking him for advice on that front. And then when I finally completed that and got a little bit of cash out of the business that I had purchased these 2 houses with, he had watched that whole journey. And so I'm thinking I'm going to put it into these 2 houses. These are my returns. And he said, great, you should do that. And then go find me some more. And then, we can do it together.
I love it, man. I think it's really helpful. I'm glad you took a minute to kind of dive a little bit deeper and give us that context, because I think the thing that most people don't understand is like how to actually build those kind of connections and relationships. And you just talked about it. You didn't go to him saying, hey, I've got these deals, hoping that he was going to invest, right? And just dangling it out there, asking for advice and hoping he's like, well, here's my checkbook. You actually had a relationship and you told him what you were doing. You explained why you were doing what you were doing. And when it was working, they said, wow, that sounds great. And I see you doing it, seeing it being successful. I'm interested in doing that along with you as well. And that quote you said, right? If you go to people and you ask them for money, you'll get advice. If you go to them and you ask them for advice, it's more likely that you're going to get money. And that's the mindset, right? You really have to be thinking about how can you build relationships with people, add value to them, learn from them. What are they trying to do? And by doing those things, you position yourself to be somebody that they can partner with moving forward. So been great stuff there. And obviously you mentioned you started off with a couple houses. From there, you scaled, did that 38 unit and really started to get more into the apartment space. As you made that leap from doing a couple of single family houses to now doing really apartment syndication, working with passive investors, what was one of the biggest lessons you had to learn on making that transition?
Yeah, I had to learn first that I wasn't very good at everything. I had to get some hubris, and I also had to learn that I should commit myself to what I both enjoy and am good at. There's a concept from the Lean Startup Machine that Eric Ries wrote 10 plus years ago, and it's also a concept in well, shucks, I can't think of the it's in a Jim Collins book. If you read any Jim Collins. I think it's the hedgehog principle that you should concentrate your energy professionally at the intersection of three things: something that is economically viable, something that you can make money with, something that you're good at, that you're just better than others, whether or not that you enjoy it, you're just naturally gifted at it, and something that you enjoy. And I like to clarify, kind of emphasize that second piece of like something that you're good at, something that you can be the best at, something that you can create a category of one for yourself, even if it's super niche. So I had to learn that it wasn't just about economic viability, and it wasn't just about enjoyment, because that's where I had gotten to at that point. I had learned from growing up that everything I had to do had to be economically viable. Nothing else mattered. And then I built a study abroad company in Costa Rica, and I learned that chasing fun matters. It makes you more successful. And then I'd gotten into real estate and I had hubris. I said, I can do everything. I can automate anything. And I tried a couple of flips after 50 cash flowing assets in a row, all successful. Of course, I was riding the wave, right? But all successful. I tried a couple of flips. First two went well, bought three more at the same time. All of them lost money. I'm not a great property manager. I am not a great construction manager. I like to lean into my shiny object syndrome. I like to lean into my ADD, and I like to focus on the transactions, the capital markets and the space markets, and partner with others who can oversee the remainder. So that's what I had to learn. And that's why I started looking for partners, people who could complement my skills and my weaknesses in a way that would kind of champion my strengths as superpowers, and make me feel solid and cared for on my weaknesses.
I love it, man. Great insights right there. You talked about those three things: something that is economically viable, that you're going to make money at, something you're good at. And you said, maybe something that you could be best in class, and then something that you enjoy. And if you look for things in those three areas, you could definitely be successful. You talked about making the transition and focusing on getting partners. You are now with Spartan Investment Group. How did that relationship come to be?
Yeah. All right. So when we started the Best Ever Conference, Joe Fairless, who runs the Best Ever brand, podcast, conference, mentorship group, books, all that stuff, magazine. I said, hey, Joe, you've got this expansive network. You've had this very successful podcast these last 2 years. I'm coming off of a study abroad company where I've learned how to create great experiences for people. At least I've been told through financial outcomes that they're great experiences. How about I throw this event and you just get people to show up? And in this first year, because you've just finished interviewing 600 people on your daily podcast, why don't you recommend a couple speakers? And so we talked about it for a little bit. And he said, great, this has been on my to-do list and I've done nothing for it. Let's join forces. And so the Best Ever Conference concept was born, and he announced it on his podcast. And a couple of people reached out saying, oh, I live in Denver. I'd love to help. And so he forwarded me one of those messages, and we hadn't gotten into our rhythm of communication yet. I had thought he was saying, here's one of the speakers that you should reach out to. That man's name was Scott Lewis. who was a military officer, but was doing a couple of really cool, sizable flips, pop tops, dig outs in DC with a partner. And so I invited Scott Lewis to speak, even though neither of us knew who he was. And by way of doing that, he lived in Denver. We had both just moved to Denver. We said, yeah, let's get lunch. And then I quickly realized, oh, that was not on purpose, but heck, this guy seems cool. I'll just let him speak anyway. And he was rated the third best speaker that year. So it all worked out. And then Scott and I went skiing for about a year, mountain biking a little bit. We talked to each other about every week about what we were working on. And when a life change came for me, we investigated what it would look like to marry our business models and work together on this new lovely asset class, self-storage. So that's how we found each other. And then he spoke at the first best ever conference. He brought his other partner doing the flips at the time, Ryan Gibson. And Ryan Gibson, Scott Lewis, and I now own and operate Spartan Investment Group.
I love it, man. That's amazing. And you talked about the conference. We're going to come back to the best ever conference for sure. But I want to talk about Spartan Investment right now. So you kind of built this relationship with Scott on accident. And I was at that first conference, and Scott did a great presentation. He was so thorough. What I recall from his presentation was just the level of detail, the checklist. I mean, this guy, you talk about a military background. I mean, he was absolutely militant with his approach. And I thought that really resonated with a lot of the audience who were there. So it's great that you all were able to kick that off, build the relationship. And then the three of you go out and launch Spartan Investment Group. Now, most of our listeners are focused on multifamily. Some are, dabbling in mobile homes, maybe in self-storage. It sounds like, a lot of you all were doing flips and different types of projects before you landed on self-storage. What was it about self-storage that you thought was an opportunity and made you all focus on that asset class?
Yeah. So the original thesis was, let's find a commercial real estate asset class that meets our evaluation criteria. Ease of management, right? There's nobody living there. So there's just less phone calls to manage it. Maybe you've got some higher turnover, but just the management style compared to multifamily, which I have owned, is so much easier. It's easier to maintain. Most of these storage buildings that we have don't have any below the ground risk. There's no sewerage pipes that are gonna pop. There's no hot water heaters or anything like that. In our drive up non-climate control units, there's not even any AC. We just got concrete pads and some metal, right? So much easier to maintain, and then easier to monetize, easier to evict. Meaning that there's just we're not challenging somebody's livelihood, and so the jurisdictions aren't as restrictive on what you can do when a tenant doesn't pay. There's some states that there are, and we avoid those states. But for the most part, somebody doesn't pay, you just turn around and rent the unit to somebody else. Not too many laws governing that, or not too much time restriction governing that, I should say. So those were our evaluation criteria. And when we looked at the historical performance of self-storage over the past two recessions, it had continued to increase in value, increase in transaction volume, increase in rental rates, increase in occupancy. And now the part of that is because it just wasn't a very institutionalized asset class in 08, 09 and prior recessions, meaning that there wasn't as much debt to be able to accelerate or come due and to foreclose upon as compared to some of the major food groups. And that has changed. It has become a very institutionalized asset class, but the fundamentals of storage still made great sense. Storage did good in volatile times, whether those volatile times were positive or negative. As long as change was occurring, and we live in a world of entropy, change is always occurring, storage continues to do well. And when we talk about doing well in bad times, there's the 3 Ds: divorce, death, and downsizing. I personally don't like to take advantage of people's dismay, but people do need services even when they're experiencing negative chapters of their life. And so through 08 and 09, there was a lot of volatility. And so storage was used even more. And our American consumerism continues to create more demand, and the cost of construction just continues to have a supply constriction. We're seeing occupancy levels rise incrementally every single year over the last 15 years. So it continues to be a great asset class.
No, great insights right there. You gave the 3 Ds: divorce, death, and downsizing as some of those things that are really fueling the asset class. And I love that you talked about how previously it wasn't really institutionalized, meaning that big investors, big capital, institutional capital couldn't really come in and invest in these assets. So it really was more mom and pop investors. Can you give some context? Because I think the last time I really looked at it, or the last time someone shared some information with me, I understand that the industry is heavily focused on mom and pop operators, probably more than what most people would expect. Can you give us a little sense of what some of those numbers look like today?
Yeah, so it's a little bit misleading because I think a lot of folks talk about the number of storage facilities. There's over 55,000 storage facilities last time I checked, which is more than the number of Burger Kings, more than the number of Starbucks, and more than the number of McDonald's, all combined together in the United States. There's more storages than those three brands of franchises in the US. And more than 70%, 75% last time I checked, but I'm going to go ahead and say 71, 72% of those facilities are owned by local regional operators, not institutionalized, capitalized ownership groups, family owned properties. But that is in reference to the number of properties. And that includes a 5,000 square foot falling over shed in somebody's backyard. If we're talking about the amount of square feet, this data isn't as publicly tracked, but we're estimating about 50% of the square footage is institutionalized, has been consolidated. While the remaining 50% is still mom and pop owned. But a good chunk of that is less desirable assets.
Got it. Thank you for clarifying that, because I've seen those numbers, and I think when I saw it was like 80% or something like that, 85%. So it's good to kind of get an update as far as where those numbers lie. One of the other things that, for many of our listeners, if we're used to multifamily, we get the concept of value add, right? So we understand that I can renovate a unit, I can paint it, I can fix it up. I can maybe add rubs and bill back for the utilities. I can make the property nicer to charge more for rent. And that's how I create value with this property. Self-storage is a little bit trickier, though. Can you talk to us about how you're able to create value with self-storage? Or what is your buying criteria? What's your business plan when you're looking to go out there and buy a property?
Yeah, it's trickier if you are seeing less opportunities in how to add value, but it's actually simpler. So if you can say, oh, I actually have less options available to me, then it's not so much that it's trickier from a complexity standpoint. It's just trickier to identify the opportunities that meet those criteria, because it is simpler. So the nice thing about storage is that you're on month-to-month leases with increasing demand relative to supply. So as long as you're in a net migration trend location, you've got population growth, income growth, job growth, you're going to be increasing your street rates. And I know that you don't like to kind of time date these episodes, but in Q1 of 2022, the 5 REITs had a 22% rent growth year over year. Like nationwide of all publicly traded storage, 22% rent growth year over year. And our leases are month to month. So we can start pushing those rents to match immediately. So we often see facilities that are 99.9% occupied by mom and pop owners who are just very satisfied with that occupancy and whose rents are 40% under. So a big part of the value add is just pushing rents, and we don't have to wait for lease turnover. We just buy it, and the next day we send the rent increase announcement. We do like to boil the frog a little bit. So we have brand standards. We don't have all of our facilities as the 4-story glass facade, major highway, climate controlled buildings. We have some of those. A lot of ours are on a main drag in a secondary or tertiary market, but they are drive up, roll up facilities. We want to make sure that the roofs aren't leaking. We want to make sure that they have all roll up doors, no swing doors. We want to make sure that there's adequate signage, adequate cameras, that the office has an appeal to it. We want to make sure that you can actually rent online, which you'd be surprised how often that's not the case, that there's sufficient reviews, Google reviews and other reviews. And then a lot of times, not all the land is taken advantage of. Storage can be coupled with RV parking. So if you've got extra land, you can do RV parking. You can go to the city and get a approved site development plan for an expansion, or the jurisdiction, if not the city. And that's kind of our bread and butter deal to answer your second question. What's our favorite kind of deal? One in which we've got sizable cash flow on an existing facility with the opportunity to push rents on that existing supply. And we've got both the geographic and the market conditions to expand the facility. I have a great example in Corsicana, Texas. We purchased 81,000 square feet of storage. We had 18% rent growth on those units over a 2-year period. And we also built 40,000 additional feet. That means more debt service because you're constructing something that's not generating revenue. So your cash flow is deflated in the first year or two. But when you look at the overall project level IRR, it's much more attractive to be able to couple the spread of the cost of construction compared to the sale point of that construction with the cash flow of the existing facilities. It's just a good marriage of cash flow and upside yield on construction.
So Ben, I love everything you said, but you gave so much right there. I got to really slow it down and kind of unpack this
Sorry,
a little bit.
man.
No, it's good. I love it because one, you got excited, and it's always great watching someone get excited. And I'm starting to understand that glimpse of what you were talking about in your previous roles, right? With understanding how to convey kind of more complex topics. But, I want to play this back a little bit. So you talked about one of the things you look for is something that is sizable, right? So there's got to be enough of an opportunity there to warrant the investment. You're not chasing that shed in someone's backyard that's fallen over because you can't make enough money on that, right? So it's got to be a big enough property for you to go after it. The second thing is you talked about the cash flow and also the geographic location and the market conditions. So what's going on in this place? Can we create kind of the revenue that we're looking to? Can we implement the business plan? Which again, very similar to, I think anybody who's investing in real estate, you want to make sure that the market conditions are right, but also that you can implement your business plan. And then you started talking about expansion, which I think is really important, right? Because for you all, what you're saying is, hey, is there an opportunity to expand? And if we can expand our footprint, if we can build something that's not there today, then we have another revenue creation opportunity that maybe other people aren't looking into. And those are some of the things that I think whether you're looking at multifamily or self-storage or whatever, it's how can you create something that maybe isn't there today? And I think that unique perspective gives you a lens that maybe brokers aren't thinking about or other investors aren't thinking about. And it's just a really savvy way to approach the marketplace. So looking to create something that's not there. For you all, it might be additional storage units. It could be RV park or additional units from that standpoint, or something else that you can monetize and add revenue for. I want to go back because you started listing off some of the things you really look for, and I thought it was just amazing. And I was trying to write it down. I couldn't keep up with you. But you talked about not every property is that glass building right off the highway with, pristine signage and all of that, but you are looking for a property that has working doors, right? Working metal doors that kind of open and close properly. You said adequate signage. You mentioned as well that you are looking for kind of the land usage of the property and rental upside. So when you're going through and you're, making your list or you're looking at properties, how much of this is done kind of on the phone versus that physical inspection to check and see what the doors look like and what these facilities look like? Because I read my fast note now. It says rent online, which I was trying to say is that they are collecting rents online as opposed to, again, taking cash or having checks mailed in. So how much of that are you figuring out? Because I imagine many of these owners, especially if it's family owned, they may be, pen and paper, and taking some of this stuff. So you may not have the access that you could with a 200 unit apartment building or 200 unit, facility where you can just go online and do most of your research from a computer. I imagine some of this you do have to be in the market and kind of take a look at.
More often than not, there is a PMS involved, property management software. However, you're right. There are still lots of folks who are either running it off of Excel, or we even bought one where it was just pen and paper, to your point. So a lot of it is done online. We look at a lot of our feasibility data online. We ask for as many pictures to get a rough guess from an underwriting purpose for our pricing. We ask for as many reports as a broker or seller willing to provide in advance. We do competitive occupancy calls from the desk. We access data sources, purchase data sources for population growth, income growth, pipeline data, whatever it might be. But then we always are going to go on site. We're going to interview the managers. We're going to look in every single unit. We're going to drive by all of our competitors and stop and go in and talk to the manager and take a picture of their occupancy report if they let us. So we're going to be doing a lot of boots on the ground stuff. So in storage, in multifamily, you have the benefit of saying, oh, I've got this $50 million single address property. You don't really see that too much in storage. If you want that kind of scale, you have to buy a portfolio. So 3 times last year, when we hit over $30 million on a single transaction, we had to be flying around to multiple states. So we were sending teams of 2, a construction person and an operations person, to different properties, and they would have to drive from one city to the other, and they might hit 3 or 4 locations. Then we'd have another team, team beta, do another 3 or 4 locations, going from Tennessee to Georgia to Florida to Kentucky, whatever it might be. So we do a lot of boots on the ground work, but we try to be as informed as possible before we put in that price point, because we know that storage rents are going up so quickly that by the time we go from our initial offer to closing, we might have already gotten an 8% rent increase. It's really hard to retrade based off of the roof caving in. So we try to get as much detail about where the CapEx situation is in advance, as much detail about where they might have cost overruns or cost shortages that we need to adjust for in our underwriting in advance through our desktop study.
No, I love it, man. Great balance right there. Try to do as much work up front as you can, but obviously you've got to have those boots on the ground, getting on planes, checking out these properties and figuring out what's going on in the marketplace. And you talked about also recognizing that, hey, rents are growing so fast that you may not, the rents could increase 8 to 10% before you even, go from being under contract to closing. So you have to just consider all these things when you're looking at the property and deciding what your ultimate numbers are going to be. Ben, for anybody who wants to learn more about what you're doing in the self-storage space, they can check out spartan-investors.com. You can certainly learn more about what it looks like to be a part of their team and check out to get on their investor list. I want to go back to the Best Ever Conference, right? You talked about partnering with Joe Fairless to kind of create this and, meeting your partners there. It's a special event for me. I met my first, large syndication partners at the Best Ever Conference as well. And there are a number of investors who can say the same thing. As you've watched this event grow now, I think you're on year 6. So as you've watched this event grow, what do you see moving forward? And what are some of the stories you've heard from people as far as the way it's been able to help them grow as real estate investors?
Yeah, so I guess to adequately answer where we're going forward, I have to take a look back. So when we first launched the event, it was for folks who were very much like you and I. I was the avatar. I wanted to make it for me, and I figured if I was interested, other people would be too. And I was doing this on the side of a full-time job that was not real estate focused. So we put it, kind of Friday and Saturday on the weekend. We were tailoring it to real estate entrepreneurs and kind of making it a buffet of options. We have single family, we have commercial real estate, a little bit of inspiration, a touch of macroeconomics. And it was for folks who might be going from having done their second flip to buying a fourplex, or was also for folks who had done 100 flips and were now buying their third apartment building. But over time, we've found that a lot of the people participating, like you and me, and a lot of the people that we know, are now full-time in what we do. And we're not talking about our second flip. We're not talking about our second apartment building. We're talking about how do we go from 100 million to a billion? How do we go from having a 3-person team to a 30-person team? So we have not talked about single family for years. We are a commercial real estate syndicator, operator, and investor network. And going forward, we're going to be kind of withdrawing a little bit on the content and focusing very much on the inspirational stories of successful businesses and macroeconomic content. And we're going to kind of withdraw from some of the other content and leave more available space open. Because what we found is over time, the higher the price point is, the more progressive and intellectual 301, 401 level content is on stage, the more that folks self-select to be in the audience. And that audience quality is the entire thing. People might think that they're showing up for the cool speaker, or they might think that they're showing up for X, Y, or Z, but they leave feeling like that was worth it because of that random person I met who tapped my shoulder, or whose shoulder I tapped. So everything that we do at Best Ever Conference is about increasing collisions per capita. How can we consolidate high quality people and have them collide in a qualitative way, in a deep way, at a higher rate of collision, such that more activity blossoms out of that network? We have nothing to sell. All we want is to create a great place for people to come together and transact with each other, partner with each other, learn from each other, party with each other, have a good time, have sounding boards for their businesses, and just enjoy each other. And so in its 7th year, next year, we are expecting 1,500 people on our own. We're going to be adding things like speed networking to the roster. We're going to be doubling down on our pitch competition and finding ways to offer rewards for that, and kind of filtering in advance and having more audience participation there. But most importantly, we're going to start partnering with other content producers, kind of like South by Southwest, where they've got a main stage, but the entire town of Austin is taken over for dozens of different content producers to be talking at the South by Southwest arena. So, I've got 2 or 3 that I'm not ready to mention yet, but 2 or 3 other investment groups that are going to be having their own tailored content with their own exclusive pass at the Best Ever Conference, so that folks who might not have come to the conference before are going to be looking at their content as well as ours and becoming part of the mix. As long as it's a complementary audience quality, it's only going to continue to blossom.
I love it, man. Some exciting developments there that you are working on for the seventh best ever conference. And like you said, it's been a great platform. I've watched it grow and we've been able to grow with it. And you've obviously have grown and Joe as well. So I love what you said about the collisions per capita because it's networking on steroids, right? It's very intentional. It's trying to figure out how can you connect people who need to connect with each other and help them grow and creating an environment where that is organic, but encouraged as well. And it's not just luck and happenstance, but it's people who are there to meet other people who can help them accelerate their business. And as you said, go from, a $10 million portfolio or $100 million portfolio to a $1 billion portfolio. I mean, really to 10X kind of what you're doing there. With that said, if you want to learn more about the Best Ever Conference, go to besteverconference.com and you can register today. I know you've already sold a few hundred tickets already, so it is exciting to see the progress as well as the success. But go to besteverconference.com if you want to be a part of that amazing event. All right, give me a failure or an apparent failure that set you up for later success.
Yeah, when I did those 3 flips, I lost all the money, John, all of it. all the upside, all of my principal investors' money, and then I dumped more good money after bad. And then I eventually had to cut my losses. So I never recovered with those deals. But what I did was I had been lucky enough to be successful enough that one of those first 2 properties that I owned, I had paid down to zero. I had a 15-year mortgage. It was just super small. I'd been able to pay it down to zero. So I got a HELOC on that property. And it allowed me to pay back my investors, even though they were equity investors and I didn't have to. It allowed me to pay them back 100% of their principal plus 8.5% annualized. And that was important to me because when you're in your 20s, you've got decades of runway ahead of you. You don't want something so small like that to be a blemish on your record. And these were my very first relationships that had taken a bet on me. I was not going to let them take the heat for my mistakes. And it wasn't an environmental mistake. It was an operator mistake. It was me.
Give me a digital or mobile resource you recommend for your business.
Digital or mobile resource? Ooh, for the business. I would just say, if you can't afford it, go best in class with everything that you can, as long as it integrates. So we're using Salesforce for our CRM. We're using NetSuite for our accounting. We are using, I'll just leave it there. Just go best in class. Sorry, that's not a great answer. Put me on the spot.
It's all good. Give me the book you've recommended or gifted the most in the last year.
Yeah, I have 2 authors that I have both talked about a lot and given books about on behalf of to others. Carlo Rovelli is an Italian gravitational loop theorist who makes physics accessible to the layman and makes it very romantic. You throw that guy on Audible, go for a run, observe nature, and you're just like bewildered about reality. It's I'm very much of the belief of consuming Renaissance content makes you a better businessman because you can see the puzzle pieces of the entire lived experience and plug them together in a way where you can see patterns better. And that's all this is in investing, right? It's just pattern recognition. The second author is Yuval Harari. A lot of folks know about this one. He is an anthropologist that wrote Homo Sapiens, Homo Deus, and another third book that I haven't read yet. But he just helps expand the mindset from looking back 2 generations, 4 generations. And when we're talking about cycles and where things are going, again, about that pattern recognition, only being able to look back 2 generations, 4 generations, 5 generations to the Civil War, things that are right in front of you, stories that people have told you in your childhood, that's your limited understanding. If you can go back 12,000 years from when the species became the only homogeneous remaining on the planet, and how we became an agrarian society, and how we've defeated our primary agenda of disease, war, and famine, just tanking our ability for our species to perpetuate, and what is the agenda of the human species going forward. If you can watch that trajectory of the organism of the human species, you can, again, have better pattern recognition to predict what's going to happen tomorrow.
What's a daily habit that helps you stay focused on your goals?
Meditation. I do the 10% happier app. So 10 minutes every day, 11:15 a.m.
All right. What's your number one insight for investing?
Number one insight for investing is bet on the team before you bet on the thesis or on the asset. A great operator can make a deal go well, a terrible deal go well for an investor, and the best deal ever can be tanked by a nefarious, duplicitous investor. So trust the team, look at their values, look at how their actions match their values historically, and build a relationship with the team, or consume the content that they have to know that they are who they say they are, and they're going to do what they say they're going to do.
All right, let's wrap it up, man. You are out in Denver, great place for food. Give me your give me your favorite place to grab a bite to eat.
Favorite place in Denver? Oh, it's not New York, man. It's not too many places. The thing I miss the most. But I'm gonna go with Linger in the Highlands, just across the Platte from downtown Denver. Linger is good eats.
Love it. Listen, Ben, you gave us a lot of great things. I really enjoyed hearing your story and your origin story, man. I've known you for a while, but didn't really know all that with your background and getting started. And it just helps to really understand the way you think and how you were able to have some early success, with these homes, these rental properties, using that to grow and to scale into apartments and syndication, ultimately getting, paired up with Joe Fairless to do the Best Ever Conference, meeting your partners there, and now taking Spartan Investment Group up to, $500 million in portfolio and assets under management. So I just think it's incredible listening to your story and how you've been able to grow and be successful and help other people. Again, if they want to learn more about you and what's going on with Spartan Investment Group, they could go to spartan-investors.com. The Best Ever Conference, go to besteverconference.com. You've got a personal website too. What's your personal site for them to reach out?
Yeah, if you want to see what I'm reading, you can go to benlapidus.com. I keep my reading list up there.
Ben, pleasure talking to you and catching up. We look forward to staying in touch, and we'll see you again soon.
Right on. Thanks, John. Thanks for having me.